The repurchase agreement or the repo market is an important part of the financial system that has drawn increasing attention lately as well. On an average, in the US, about $2 to $4 trillion of repo agreements sells every day. But how does this market work? And how is a repurchase agreement used by the Fed to perform its monetary policies? In the previous video, we looked at tri-party repo. In this video, we'll look at repo and the basics of it. Hey, it's Selvan Theo from Lambda Edge, where we look at finance and technology. If you're new here, make sure you click that subscribe button, and all the links and everything we mentioned in this video will be available in the description box below. A repurchase agreement or repo is a short-term secured loan. One party sells securities to the other and agrees to repurchase those securities at a later date at a higher price. Let's look at a typical repo transaction between a primary dealer whose security is rich with that of the cash investor who's cash rich. The cash investor typically is a money market firm who wants to get a little bit of interest for the positions they have. The security serves as a collateral, and typically the security's value is often less than the cash paid. This difference is called as the hacket. In our case, in this example, is 0.2 billion out of 5 billion. In the opening leg of a repo transaction, the dealer receives cash and in exchange of securities with the cash investor. In the closing leg of a transaction, the cash investor receives the cash and returns the securities. However, as you can note, the value of the cash returned is going to be higher than the value that was borrowed initially. In our example, it's going to be 4.82 billion, and the $0.02 billion is the difference which is paid as interest, and a repo rate can be calculated as shown. The repo market is important for at least two reasons. First, the repo market allows the financial institutions that own a lot of securities, like the broker dealers, the hedge funds, to borrow cheaply and allow parties with a lot of spare cash, like the money market mutual funds, to earn a small return on the cash. The second one is the Fed's open market operation. We will see that later in this video. Now, let's understand this repo function with a market maker of NASDAQ as an example. NASDAQ, as unlike NYSE, is made of market makers who buy and sell securities. Their business model is to earn a spread between the bid and the ask price. As you can see, the bid price is $109 and the ask is $106. They make a difference of $3 when they sell or buy into this position. But to make this happen, the NASDAQ market maker needs to have a large portfolio of securities. But how do they finance their position? That's the important question. And the answer lies in the repo transaction and the leverage that a repo typically gains. Now, to understand leverage in the repo market, let's assume a NASDAQ broker dealer with cash of 1 billion and he buys securities worth of 1 billion. Then he can repo the securities with a hacket of 5% by getting $950 million. Using this $950 million, he can further buy securities worth $950 and then further repo them out. Continuing this process endlessly, he can create a portfolio worth $20 billion with an initial investment of $1 billion in cash. That's the amount of leverage, 20 times that he can actually lever his portfolio to make this market making function. As noted, the second most important function the repo performs in the US is Federal Reserve's open market operations. The Federal Reserve uses repos and reverse repos to conduct monetary policy. The Fed does this by crediting cash to itself and then enters into repo agreement with the primary dealers. When Fed buys securities from the seller who agrees to repurchase them, it is injecting reserves into the financial system, as shown here. Conversely, when the Fed sells securities with an agreement to repurchase, it's draining reserves from the system. The rate at which this is done is usually called as the repo rate, and these days, because of the LIBOR replacement, you have secured overnight financing rate. If you want to know more about LIBOR and its replacement rates, check out my video on the LIBOR rates. This secured overnight financing rate as of August 27, 2020 is 0.07 taken directly from the Fed's website. And the volume of repo transaction that has happened on that day is about $898 billion. So these are the two main functions of repo, and hope you have understood the basics of repo and the functioning of this in the US market. Thanks for listening.